It looks like there is no stopping gold. The yellow metal was flirting with the key level of $2,000 per troy ounce for the past 2 weeks. And on August the 4th, it finally soared past that mark for the first time in history. Spot gold is up more than 30% so far this year. But why is gold going up? Traditional customers in India and China are not buying. The World Gold Council's latest report showed jewellery demand has nearly halved for the first half of this year to 572 tonnes.
There's lots of heightened economic risk, financial uncertainty, and in times like that you see an increase in investment demand for gold. It's seen as a hedge against risk, it's seen as a safe haven.
That investment demand for gold has fueled record inflows into gold-backed exchange-traded funds, or ETFs. The World Gold Council said first-half inflows hit 734 tonnes, way more than the previous annual record in 2009. There are other reasons prompting investors to park their wealth in gold.
Central banks are creating a lot of new money in order to create subsidies for the economies, so rebalancing the economies which are right now in dire straits and need support. So this money creation is nothing else than a rights issue on a share, and that means your currency is debasing, your money is debasing, and you question actually, why do I still save in money to get no return? But gold has actually been holding the value, and I think a lot of people in these economies will come back to the old tool of savings, and that's basically gold and silver.
The global response to the COVID-19 pandemic has also created a situation where interest rates are near zero. In this ultra-low rates environment, gold presents a more attractive investment proposition.
Gold doesn't pay a yield, but now you look at other asset classes like cash or bonds, it's paying no yields or even negative yields.
Coupled with increased geopolitical risks globally, the tensions between the world's two biggest economies, the US and China, market experts see further upside for the precious metal.
We have 200-odd trillion worth of money sitting in fixed income. Then you've got about, $80 trillion worth in equities, which looking slightly stretched. And you have only about 0.5% of that total wealth, which is exposed right now to gold. And I think at peak times, we've been somewhere between 5 and 10%. We're going to start moving up that number of 0.5, and that's going to create and creep up and basically keep creating higher highs and higher lows.
So who are the biggest investors of gold? Central banks have been net buyers since 2010 and account for about 15% of demand.
They buy gold for the same reasons that institutional investors buy gold. For its physical properties, it's a safe haven asset, it's a good portfolio diversifier, and it's also very liquid. So central banks, when they're thinking about reserve management, one of the issues is liquidity, getting access to dollar funding in particular at short notice. Gold is considered a very liquid asset. It's a source of emergency funding.
A new group of investors has also emerged.
These last 18 months, it's been first family offices, very high net worth individuals. And now we start seeing that actually private banks are starting to jump on the bandwagon, which still have close to zero allocations in their portfolios and moving the allocations up in the portfolios. So that's going to be the next drive. And I think the last one will be probably a bit down the road, be the retail money.
Gold-backed ETFs are one of the easiest and most convenient ways for these investors to gain exposure to gold. But before they pile into these investments, investors should be aware of the risks associated with gold ETFs.
Most ETFs, they claim to have gold backing, but they might not have really physical gold in their structure or only a fraction of that physical gold in their structure. Or they have outstanding receivables of gold to receive. That's not quite the equivalent, particular environment where you have shortages in the market and the bullion banks and shorts are scrambling to cover. So people should really look who has actually a fully covered ETF if they participate in one.
State Street Global Advisors manages the largest physically backed gold ETF, the SPIDER Gold Shares ETF.
Most of the gold ETFs are fully backed by gold, so they have gold in the vault. So each shares are basically backed by physical gold. If you choose the right gold-backed ETF, there's very limited risk because the vault it's held somewhere, very secure, and it's very limited counterparty risk because the gold is fully backed by physical gold, and also the gold is fully secure in the vault safely for the investor.
There have also been instances where different investors ended up laying claim to the same gold bars. To protect themselves, ETF investors should ask two questions. Is the underlying asset fully backed by physical gold? And is it an allocated product or not?
There's something in the industry called allocated gold, and that means each bar has a serial number. And with an allocated gold account, as an investor, you have ownership over a specific bar, which means that from a legal perspective, you have the legal title to that bar. So the custodian, the bank or the online account provider, doesn't own the gold on your behalf, they're just storing it for you. So in the event of some kind of credit issue, you're not a creditor, you're the owner. Which from a legal perspective is obviously very different to a product that might just be what we call pool allocated or unallocated, where you have a general entitlement to gold. You then become a creditor in the event of a counterparty issue.